All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. I have a few things here we need to do with the challenge. We don't have any new triggers on the board right now. So I'm just going to do one thing, and that one thing is I'm going to pull off Halliburton and move on from that. We're hitting our red stop here. It's basically at a position where, we entered the price at 2101 when the stock was at 2101. And it's now 2087. So the stock has gone against us a little bit, here with the action today, which, really isn't that bearish of action today. In fact, I might find myself personally wiggled back into the position here today. But for the challenge, per the algorithm, need to pull it off and move on here. So going to put an order in for 82, see if they'll fill that here. Maybe not. On a day like today, where just things aren't moving, fills can get a little interesting. So let's just come in here to market and pop that in. So 81 is my exit. So 81 cents is the exit there on Halliburton. It gave a little bit of indication yesterday it was wanting to go, but it just has. It has been nothing but a time sink here, which is not different from a lot of stocks out there, where the time decay on the options, and then we're seeing the implied volatility on options fall off as well. So we're taking a double dose of hit. It's not really all delta when it comes to a lot of these positions. There's a lot of vega and theta loss that is coming into options in general right now, which is typical this time of year. And was one of the reasons I didn't want to get into either IBM or Starbucks yesterday. I did not want to take that additional risk there, but 0.81 is the exit price. Closed there on Halliburton. So that's not going to help our numbers, our overall run rates here. In fact, it's going to set us even further behind the curve there of what's expected. But again, like most trades, it's not going to make or break the challenge. And this one, small setback and moving on. Now, I am going to hold Netflix. Now, I know the option is down $75 from where we got into, this part of the option. But if we do look at it, the stock entry price was $311.71. Right, 311.71, and the stock's now trading at 313.72. So the stock is up $2, right? You say, well, why the stock's up $2? Why are we down on the option? Well, it has everything to do with the time decay and implied volatility elements, that are simply coming into stocks right now. So we have a trade delta. We should be up about $120 on the position. Instead, we're down. We're about $200 off of that. Tells you that we've seen a few Vega points come out, and we've had 3 days worth of theta. So we've had about 4 Vega points and 3 days worth of theta come out there. Well, plus the weekend. So. That's just kind of what's happening with stocks or with options in general. And, nothing unusual this time of year. In fact, very normal this time of year. But not much fun. But I am going to hold on to the Netflix position as those principles are still in play. And, I do want some exposure here, and it's still a great chart and everything else here with it. I guess no real downgrade on Netflix today to drive it lower so it can pop back up, I guess. But anyway, we do have a bunch of crossover action going on out there. Here, the upside crossovers, none of these qualify as a signal. 2 airlines, American Airlines, Delta. I really want to play American, but just not a signal there. JD, Procter & Gamble, Under Armour, Whirlpool. On the downside crossovers here, we do have a few Dollar General and Juniper. Juniper, you'll recall, was on the upside crossover list yesterday, didn't qualify as a signal. Now on the downside list, not qualifying as a signal. We just have a lot of that, just a lot of that out there in the market right now. Now, we did have 2 signals yesterday that I said, if I'm forced out of Halliburton or Netflix, I'll take a look at getting in. One of them was Starbucks and the other was IBM. I've looked at both of them. I'm just not that interested. I'll wait. I'll wait for the next signal, and rather than jump in and be subject to the time element here, and just another flat day or two in the market that it's just going to eat up option value. It's just not worth the risk right there. So making a conservative decision, obviously, there with it, but just given what's going on out there, it's just not worth it in my opinion there. So going to go into the close here today with Netflix and continue running here with Netflix, and come on, let's go. And we'll look to react to the next signal. We do have plenty of cash here, about almost $2,000 in cash right now, so plenty for the next position or the next signal that comes in on the board, and we'll be good to go. All right. Want to talk about a couple stocks, and let's go take a look at this company, Triple M, right? They make Post-it notes, right? No, they do a lot more than just make Post-it notes, but this is a stock that we've talked about several times, and we talked about it right back here, and I said, look, one of the best trades on the board right now is to short Triple M. Short it, but as a hedge to go in long either Honeywell or UTX, right? So you go buy, Honeywell or UTX, and, what's happened over the last 6 months? We've seen both Honeywell and UTX go up. We've seen Triple M go down. And so this is one of those combo trades where the long made money and the short made money, right? If we come in and we look at the kind of price performance here, of these, right? So let's just come in here to Triple M versus, let's take Honeywell, for example, okay? We can see that it's a 32% difference in the performance over the course of this chart. Now, I'm going to set this chart up just a little bit differently. And let's just go from this earnings day, because that big earnings gap down, does affect it. And this was, I believe, April 24th, I believe. Let me get the exact date. April 25th, right? So let's just go from the 26th, and let's kind of see what this looks like. Okay, because I'm going to talk about a trade that's set up right here, right now, to be made that's very similar. Okay. So let's go 2019, April 26th to today. Let's get rid of our other indicators, because we're not using technical indicators for this trade at all. This has nothing to do with technicals, which I know for some, how dare you make a trade that's not technical based. But look, there are a lot of other good ways to trade out there, and one of them is based on fundamentals, and that's what this is. So here we are since that earnings report. If you were to basically short Triple M, go out and short, $1,000 worth of Triple M, long $1,000 worth of Honeywell, which I know if you're playing stocks, you're putting more into it than that. But you essentially have a 14% difference, right? You've basically made 14% on the trade. Pretty good trade, right? Especially for a stock. Right? If you did this now instead of with Honeywell, but used UTX, and we talked about you could use either one, UTX, you're up 15%, right? So Honeywell, UTX have kind of done the same thing, and both have done something very different from Triple M. Okay? You say, okay, well, what does that mean about now? Well, we talked last month, this trade's over. This trade's over. Long UTX, long Honeywell, and short Triple M, it's over. It's done. It's kaput. I'm out. I'm done, right? The trade is now reversed. The trade is different. And I want to show you why, okay? This is one of those trades where, from this point forward, long Triple M and short Honeywell, or long Triple M or short UTX makes a whole lot more sense. And I'll show you why. Number one is, well, we have the earnings. The earnings debacle that Triple M had, it's over. It's played out. It's done, right? They have, we're now well removed from it. And, that piece that kind of created that rotation for investors, investors have already made that rotation, right? It's a 16% rotation. They've already done it. It's no longer happening. And so going forward, how are investors going to look at these companies, look at these stocks, and say, how do they compare, right? Well, if we come into the fundamentals, let's just take Triple M, for example. All right, there's a market built on revenue. What's going on with Triple M revenue? Well, Triple M revenue has been shrinking, right? And it was that earnings report that showed their revenue was going to start shrinking that, pretty much sent things down. What about Honeywell? UTX? Well, Honeywell had a little bit of shrinking revenue. Some of that was due to a sale, but, UTX has had, continuing expanding revenues, beautiful revenue growth during 2018. So Honeywell, UTX, both better revenue stories than Triple M, right? And you say, okay, well, that's why we saw the discrepancy. If we come in and we take a look at both companies on a or all these companies on a price to sales basis, right, which is a great valuation metric, we're going to kind of see the same thing. That these companies just basically, the price to sales moves with the stock. There's no real, no real divergences, nothing where you go, well, this company's cheaper than the other. UTX maybe a little bit, but price to sales doesn't really much matter. What about price to book value? Price to book value when it comes to Triple M is at 9. Okay, does that mean a heck of a whole lot? Not really. What about with Honeywell? Price to book is up here at 7. Does that mean a whole lot? Not really. What about UTX? Right, price to book is 3. Does that mean a heck of a whole lot? Not really. Right? From that, you go, UTX is the cheapest. Great. But all three of these companies have dividends. Dividends matter when it comes to trading big blue chip dividends or big blue chip stocks. Have you ever heard of the dogs of the Dow theory? As you kind of go into January, the dogs of the Dow, basically the best dividends for the Dow in January tend to outperform the lowest dividends, right? Now it's not one of those all the time types of things, but it is one of those things that we see stand out from time to time here. So let's go take a look at the dividends. What about UTX? Right? UTX's dividend right down here at 2%. And in fact, look at UTX. Historically, when their dividend hits 2%, what does the stock do? Does the stock rally or does it fall? Every single time we have seen the dividend hit 2%, we have seen some sort of significant sell-off come into UTX. It's not much of a dividend, 2%. Well, let's compare that to Honeywell. Honeywell's dividend is what? 1.88%, almost 2%. Right? We've seen Honeywell's dividend get down here before, and they've almost always had some sort of sell-off afterwards. Particularly when we look over the last 3 years. So these two stocks have a cheap dividend. Why? Well, the stocks have been going up, right? So, your dividend yield isn't gonna rise. It's actually falling. And we see that all the time. Not a negative, but if you're an investor looking to get in right now, and you compare Honeywell UTX now to Triple M's paying a 3.5% dividend. This is historically high for Triple M. Take a look at when Triple M has hit highs on their dividends in the past. Right here in 2012, it was after a sharp sell-off, and then look at the stock rally afterwards. Right here in 2015, 2016, right? Sharp stock sell-off brought it to these levels, and then what happened afterwards? Beautiful action. Triple M hit almost a 1.8% dividend, kind of where UTX, where Honeywell is right now. That's where Triple M started selling, right? Now it's up here at 3.5. What's more likely to happen? Are we more likely to see the dividend yields normalize within the group? Are we likely to see UTX and Honeywell be vastly different from Triple M? Well, when you go through the earnings reports, right, and you look at what's going on, all three companies, they're basically doing the same thing. They're operating similar, in a similar fashion. They have very similar metrics, right? We're not this isn't comparing, something like Intel to AMD, where, yeah, they're in the same industry, but, their stocks move for much different reasons. This is something where we have three stocks, three big blue chip names. They're all in that kind of heavy industrial sector, all that global economy, tide and all of that, where we have now seen the action of 2018, and rightfully so, take Triple M to a point where the dividend is really juicy compared to UTX or compared to Honeywell. If all three companies operate about the same in 2020, which company is going to outperform? Are we going to see Triple M, Honeywell, or UTX outperform? And we're going to see the one with the best dividend be the bigger outperformer. And I would not be surprised to see in January and in February to see Triple M outperform Honeywell and UTX in a significant manner. Right? That doesn't mean Honeywell or UTX have to go down. Just say Triple M is going to go up by more. Right? Or if all three go down, Triple M is going to go down by less, right? This is not an option trade. This is not something where you go buy calls on one and puts on the other, because then you have time decay and everything else that eats into your gains, eats into your profits. But if you're looking from an investment standpoint, please take a look at Triple M versus UTX and Honeywell. Check them out. Go take a look at these, and this is just one where we see the setup. We see the action here when it comes to the dividend, a normalization, what's going to happen. We see this happen, from time to time out there in the market, where they become fairly clear, fairly obvious, where you can get in without a huge amount of risk. And right here, Triple M long, Honeywell UTX short is a very interesting setup. Now, you could just go Triple M long, right? I would not just go Honeywell or UTX short. In fact, I do think there's a good chance we continue to see Honeywell and UTX go up. So I would not just go short one of those names. But, just kind of the way it sits, Triple M long, I think it's the more aggressive play. Triple M long with a UTX or a Honeywell short, and I'd probably short Honeywell over UTX, just simply because UTX does have a few advantages over Honeywell fundamentally. But, this is one of those combo trade setups that, really interesting out there in the market right now. It's not one you have to go rush into right here, right now. This is something I expect to really start to take hold, come January, February, March into next year. All right? Okay. Thanks for hopping on. Have yourselves a fantastic evening, and we'll talk to you tomorrow. Take care.